Welcome to Daybreak Australia. I'm Annabelle Droulers. We're counting down to Asia's major market opens.
And I'm Paul Allen in Sydney, where trading's just come online. The top stories this hour. Asian stocks facing headwinds after Wall Street's worst Fed day in almost a year, with big tech leading losses. Jay Powell hosing down hopes of interest rate cuts beginning next month.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, but that's to be seen.
Qualcomm falling after the bell as the world's top supplier of smartphone processors warns inventories remain bloated even as the industry begins to recover. And Boeing jumps as earnings beat expectations, and CEO Dave Calhoun publicly admits responsibility for the Alaska air panel blowout. All right, let's take a look at how we're tracking here in Australia. Market just open for trade. We have a staggered open, but already we're seeing some modest declines here. We did hit a record high on the ASX yesterday, but yeah, that's going to be short-lived. Thanks a lot, Jay Powell and the Fed, for that. We're backing off those highs very much as we speak. And yields also falling across the curve here in the bond space. We've got the yield on the Aussie 10-year right now, 3.9566. None of this comes as a tremendous surprise, of course, as we saw US equities falling off the back of that Fed press conference as well. The Aussie dollar 65.5 cents thereabouts versus the greenback. We've had New Zealand trading for a little while. Let's take a look at how that's doing. Again, no huge surprise here. We've got stocks off by 1/3 of 1%. We've got futures for the Nikkei also in negative territory, although futures traded out of Chicago in modestly positive territory, but we've got a much stronger yen as well, 146.82 there, Annabelle.
Yeah, Paul, well, it's really all about the Fed, and if stock bulls have been expecting any sort of rate cut by March, it does seem like a little bit of cold water was poured on that in the prior session. So you're seeing futures just coming online here, some very, very small gains so far, but put it in context in the moves in the prior session, because the S&P 500 dropped 1.6%. That is the most that we've seen since September, and it's actually the worst day for US stocks on a Fed day going back to March of last year. A lot of the losses really feeding through in the tech space, so you did really see that playing out. Also, that impact of earnings still coming through. Qualcomm, as you said, one of the ones reporting after the bell. The dollar, little change, and you're seeing as well WTI coming online here, fairly flat so far. Jay Powell, he is somebody who seems to want to be able to keep his options open, and here is something that he wants to see before rushing to cut rates.
What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, a sustainable path down to 2% inflation?
Let's get more on the Fed decision with our next guest. Thomas Honig is a former Kansas City Fed president and now a distinguished senior fellow at the MacArthur Center. So, Thomas, was there anything that sort of stood out to you in today's meeting as a surprise, or the press conference for that matter?
I think the only surprise to me was that the market seemed to be surprised, because it's been pretty clear that they were not going to raise rates today, and that they were not going to be in a rush to do it in March, because number one, the U.S. economy is actually growing well and even above trend over the last half year. Inflation is coming down, but year on a year basis, it's still well above the 2%, and year over year is what they're looking at. And finally, the market, the labor market in the U.S. is still strong. It's moderating, but at 3.7% unemployment, and there's not a big expectation for a big increase in unemployment on this Friday's jobs numbers. So, I mean, they're going to hold the course right now. And they keep saying that, the real interest rates are going up. But if you look at the 10-year, which what a lot of pricing is made off of the 10-year in the U.S., it's 4%. And, that's not a particularly high real interest rate when you think about the inflation around that. So there's no real reason why the Fed would be in a hurry to cut rates at this time.
Yeah, as you said, it has really been the US economy showing so much strength. Is that something perhaps that's taken you by surprise, given we have got rates still at very, very elevated levels, historically speaking?
Well, it's a matter of which history you're talking about, actually, because, the U.S. got used to, maybe the world got used to zero interest rates or 1% interest rates or 2% interest rates. But, in another period where we had a strong economy, growing steadily, interest rates of nominal interest rates and the Fed funds rate of 4.5%, 5% were not unusual. So we're at 5.5%. Real rates are maybe 1 and 1.5%. That's not something that I think is particularly aggressively tight. And I think that's one of the reasons the economy has gone well. Also in the United States, we have a very stimulative fiscal policy. We've had it for through the pandemic and afterwards, and that's only being backed off slightly as we look to this year, an election year in the United States.
Well, you talked about how the only surprising thing was how surprised the market was. Perhaps unsurprisingly, again, we've seen some repricing around expectations around a March rate cut. Now, hovering around about 37%, we do have a chart on the Bloomberg terminal that illustrates that. But looking ahead, would you say with any degree of confidence that May is now a live meeting? Do you think that's when we're going to see the easing start?
Well, the answer to that is it depends on how the economy is doing. Now, I think there are better odds because the economy is slowing and inflation is coming down. And if those continue to May, there'll be a pretty good case for cutting rates. And I would also point out that in the United States, the largest banks in the United States are very strong in the sense that they're diversified. They've had good earnings at this point. But the regional banks and some of the larger regional banks and smaller regional banks, they're under some pressure. There's not only duration losses that is in their bond portfolio, but their loans are under pressure given these more recent higher interest rates. And so if the banking industry gets into any kind of a downturn, that'll put more pressure on the Fed to lower rates at least by March. I mean, at least by May, if that were to happen.
Yeah, more broadly, do you have any concerns about the amount of debt that the US government is carrying as well? Is there some risk around that? What are the implications?
I think there's real risk around that. Think about it. The United States has to fund about $500 billion of new debt every quarter. It has to refinance debt that the Fed is not buying because it's on its quantitative tightening mode. That takes liquidity out of the system and puts some pressure out there, especially as the government has to fund this new debt. Now, remember, the foreign buyers of U.S. debt are tapering off to a degree. The Fed's not buying that debt right now. That leaves only the private sector in the United States, banks and other investors. And that means you have to crowd out the private sector from borrowing. So that's going to put more pressure on rates rising as we go through this first half of the year if the economy continues to do well. So yes, that's an issue. And I think the Fed knows that. And if they're lowering rates now and then that pressure comes later, they're gonna have additional, I think, strong issues about lowering rates. At that point, they're going to need to. But if they've already lowered rates, it's going to, I think, send some really mixed signals to the market.
Well, Chair Powell, as we've become accustomed to, was cautious with his language when talking about the avoidance of a hard landing or a recession. Would you say with any confidence that those things are avoided and that inflation is defeated as well?
I would not say that. I think we have a regional banking system and a leveraged economic system in the United States. Something could go wrong easily with rates and loss of confidence. No, they have to work their way through this, and that's what they're doing, carefully, cautiously, and hopefully they get through this by the end of this year, next year, and then they might be able to declare victory, but not now. It'd be way premature.
There has been a little bit of debate as to whether the last mile of disinflation is more arduous than the rest. Where do you stand on that?
Well, I think it is, because a lot of the inflation taken out of the U.S. economy and maybe the world economy has been because supply disruptions have been addressed. And we are in much better shape on the supply side. So now you have basically, this is demand, primarily demand-driven inflation. It continues. We have strong wage gains in the United States. We still have inflation in services, particularly, and that may also increase in goods. So there's a lot of inflationary pressure on the sidelines right now. And if the Fed were to ease too soon, those inflationary pressures would reemerge, I think, fairly quickly. And the Fed realizes that. And they have to be, that's why I'm saying they have to be very cautious on how quickly they lower those rates.
Yeah, caution prevailing there. Well, that's Thomas Honig, former Kansas City Fed president and distinguished senior fellow at McCarter Center. Thanks very much for your time. Some breaking news as well, just crossing the terminal in the last couple of minutes. It's the Hong Kong Monetary Authority. They've held their base rate at 5.75%. Now, the Monetary Authority, we know it follows the Fed in lockstep because the local currency, the Hong Kong dollar, is pegged to the greenback here. So that HKMA holding its base rate at 5.75%. We have seen borrowing costs in the city really surging over the last couple of years, and it's something that's really putting pressure on the local economy, particularly when you consider the differences, Paul, that we're seeing in China.
Yes, indeed. All right, still to come, AmCham China President Michael Hart's going to give us the first look at their latest China business survey as Beijing takes steps to shore up investor confidence. First, though, Qualcomm still seeing a shaky recovery for the global chip sector, while AMD talks up its AI potential. The latest signals from big US tech earnings up next. This is Bloomberg. Well, Qualcomm shares are down in extended trading after the company says some of its customers are still working through gluts of chip inventory. The warning overshadowed its otherwise solid earnings report. Bloomberg Intelligence says that could suggest the start of a turnaround in smartphone demand. Senior semiconductor analyst Kunjan Savani joins us now with more. So, Kunjan, tell us about what this means for the smartphone market.
Yeah, I mean, look, when you combine Qualcomm's better than expected earnings with Skyworks and Qorvo, all of them lead to a same signal that the Android market, especially in China, has begun its recovery. Even though we are not out of the woodworks yet, but it's slowly and steadily recovering. So that's a good news from these earnings.
What about the share gains then that we saw at its major buyers, Apple and Samsung?
Yeah, so they extended their contracts with the licensing contract with Apple and the chip contract with Samsung. So those are two very positive signs. I mean, the licensing contract does not bring any increase to the run rate, but it does extend their contract with Apple through March 2027. So that's a very good signal that, Apple, it could imply that Apple is still not ready with their chipset and will continue to stay with Qualcomm at least for the foreseeable future. And on the Samsung side, it also gives some predictability that we can assume a certain share for Qualcomm for at least few years. They didn't specify how many years, but at least few years that Qualcomm will still have that sort of a majority share in the Samsung coming premium devices.
How about the trajectory for the automotive segments? What did we learn there?
Yeah, I mean, so, Qualcomm, unlike most other auto semi companies who have been reporting weakness here, is still came out better. Couple of things. Look, the scale for them is still very small compared to a large auto semi chip player. And it was primarily driven by the timing of new car vehicle launches. As we see the newer version of the cars getting launched, whether they are in the high tier or sort of the mid tier, all the cars have much higher silicon content, especially when the infotainment and the digitization of the car. So that's where Qualcomm is playing at. So as the new car launches continue, they will see that content increase come in. And they have a couple of times reiterated that they are on track or slightly ahead of track for their $4 billion by 2026 auto revenue targets.
What were the weaker spots that you looked at in particular? Because chips for internet-connected devices, that's been signaled as one of them.
Yeah, I think there's nothing unique for Qualcomm happening here. This is what we are seeing industry-wide. Industrial, edge networking, and consumer all are going through their sort of bottom. So nothing specific. We didn't see any more than feared weakness here. This is sort of what we were expecting. What I would have liked to see is these contract extensions, them giving us more detail as if there was any price increases or ASP increases coming here. We didn't hear that, so though it was still positive, it could have been more optimistic if they gave more details.
If there's nothing that's Qualcomm specific and otherwise you're pretty optimistic on these numbers, why do you think that we're seeing the stock trading a little bit lower in after hours so far?
I think it's despite a beat on the earnings, people are still, we are not out of the woodworks, as I said, for the Android market. Yes, these are some signs of life, but we still, there's no more big catalyst for the next 2 quarters. And so the next catalyst, which will be at the launch of the next iPhone coming towards their fiscal 4th quarter, that's too far away. So there is no other catalyst that can drive significant upside to these numbers. So hence you see that priced into the stock.
That was our Bloomberg Intelligence senior semiconductor analyst Kunjan Subani. And let's stick with the chip theme because AMD shares paired some losses in New York as optimism about new AI processors helped investors look past a downbeat forecast for the first quarter. CEO Lisa Su told us the market is still in the early stages of a huge expansion.
When I look at the potential of AI, it is really the single most important technology innovation over the last 50 years. So AI has so much potential to change the way our businesses work, to change our personal productivity, to really change the way we do research and a whole bunch of things. From our standpoint, we see the AI TAM growing to upwards of $400 billion by 2027. I think from an AMD standpoint, you were at our launch, Ed, in December. It was a great coming out party for the AMD, AI capabilities, and it's gone really well. I think our customer interactions, our product qualifications, our ramp have gone really well. So yes. We were able to update, some of our numbers this past week.
I think a lot of folks focused on that ramp and how it went in the quarter. You exceeded the 400 million that you told me about at that event. So it's $3.5 billion of sales this year for MI300. What's interesting here is kind of your ramp relative to what's happening on the supply side. And I wondered how big a factor supply will be in matching or beating that number in 24.
Yeah, absolutely, Ed. This is the fastest product ramp, in our history. So, we exceeded our numbers in Q4, over 400 million. We're going to grow into Q1, and we updated our full year forecast from 2 billion to 3.5 billion. The way we think about that is that's a customer demand statement. So that is customers that we've engaged in, who have made commitments to us, who have placed orders with us. We're planning for a much larger number as it relates to the supply chain. This is what we should do. We always plan for success. So, my view is it's still very, very early in the innings for AI accelerators, and particularly for MI300. But this is an opportunity for us to continue to build a major growth driver as we work with our top customers on their AI plans.
That is AMD Chair and CEO Lisa Su speaking to Bloomberg Technology co-host Ed Ludlow. All right, we've got some breaking news from the IPO space. It's Amer Sports, we understand, according to people familiar with the matter, giving guidance to this prospective IPO of $13 per share. Now, that's a bit less than the marketed range, according to this report. Now, if you haven't heard of Amer Sports, you would certainly have heard of some of their products. They include Wilson tennis rackets, Salomon ski boots, also Arc'teryx outdoor gear. Amer Sports also majority owned by China's Anta Sports Limited. So this IPO, the US IPO, giving advice or guidance to prospective investors that it's looking at $13 per share, but no final decisions have been made. The price could change according to sources. All right, we have plenty more to come on Daybreak Australia. This is Bloomberg.
We caused the problem, and we understand that. We instituted additional quality controls and inspections at Boeing and at our supplier. We issued bulletins to suppliers to strengthen the focus on conformance and reducing the risks of quality escapes.
That was the Boeing CEO Dave Calhoun speaking during the plane maker's earnings call after a string of quality lapses that culminated in a mid-air blowout. And Boeing's fourth quarter numbers, cash flow, revenue, they all surpassed expectations, but the report took a backseat to the MAX crisis. In a break from tradition, the firm also declined to give an earnings forecast. Bloomberg Intelligence's senior aerospace analyst George Ferguson joins us now. And George, really, it was that big downplay of the financial results and the shift to the focus on safety instead.
Yeah, I mean, I think, the lack of guidance, I think, it sort of indicates to me, I think, that there'll be more of a focus on driving this quality control through their manufacturing process, both at Boeing and at their suppliers. And I think, not giving the guidance is a nod to the idea that it may mean that they don't get as many airplanes out the door this year as they were hoping. But I hope it means that management realizes that if they don't really stem this quality problem quickly, they could lose market share from it, and definitely not what they want to be doing.
So you say the word quickly. This has not been the only quality problem that Boeing's experienced in recent years. How long is it going to take to fix these problems and reassure investors and the flying public?
Yeah, so I mean, they're building airplanes now, right? So they don't have much time. They want to make sure everything going through the system is of the highest quality now. Agreed. We've seen a number of problems, either at Spirit Aerosystems or at Boeing on the MAX jet, but they've all been sort of these individual anomalies, right? We haven't seen a long trend of problems, just a number of fuselages affected. Look, they only build the airplane. They assemble it in Renton. They're building a second line in Everett, but they assemble it right now in Renton, and they build most of it down in Wichita, Kansas. So there aren't a lot of facilities to go out and examine. So I think it means they ought to get it done in short order. Plus, I think they're, really what they need to do here is get more supervision on the line and more training for the employees. And again, I think they want that in short order because they are building now. They say they're building at a 38 rate, and you want to make sure that everything that goes through the factory is of the highest quality because aerospace is, just demands those tolerances.
All right, Bloomberg Intelligence senior aerospace analyst George Ferguson there. Up next, we'll find out if Japanese stocks have more room to run after a strong start to 2024. This is Bloomberg.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, but that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.
The federal funds futures contracts went from pricing in more than 50% probability of a rate cut in March to significantly less. So I think that was the big surprise.
I think that's the story. Is it May? Is it June? It's not March. It's pushing back because they don't want to rush into a cutting cycle. The Fed has won the battle on inflation.
The Fed is now thinking that March is going to be too soon for them to see that good evidence that inflation is showing good progress besides just the goods story that we're seeing, but also shifting to services. And it's buying them time.
I think we could expect quantitative tightening tapering to happen sometime, probably around the first half of this year. If the inflation continues along the same course for a few more months, then the Federal Reserve is certainly going to start to cut rates. They're just not absolutely confident that that's where we're going to be 3 or 4 months from now.
Some of our guests there on the outlook for the Fed after Jay Powell made it clear that a March rate cut is unlikely. And what a profound impact on markets that had. We saw US markets falling. The S&P posted a pretty steep decline after that. Yields began declining as well. And then here in Australia, when we opened up, well, we went backwards pretty swiftly, also reversing away from the record high that we set on Wednesday. The ASX currently off to the tune of about 1%. We've seen markets in New Zealand going backwards as well. The NZX off by about 0.4%. We've got Nikkei futures, well, unsurprisingly, they're in the red as well. S&P minis, though, already indicating that we might be in for something of a modest rebound once we get going. All right, well, Japanese stocks have started the year strongly. The benchmark Topix index gaining 7.8% in January. If history's any guide, that early performance bodes well for the market for the rest of the year. Asia equities reporter Winnie Su joins us now from Tokyo to tell us more about this historical correlation.
Morning, Paul. Yeah, the correlation actually shows that this trend, the strong rally, is likely to continue this year. So we see stocks up over 7% in January. As you mentioned, that's the most in about 3 years. And from historical data, we see that there is a slightly strong correlation between the early performance of the topics with the rest of the year. And also data from foreign investor inflow in January also tend to show a strong, positive correlation with the foreign investors buying for the rest of the year, especially when we think about how foreign investors are actually budgeting or adjusting their portfolio in January for the full year.
And was that rally that we saw in January any sort of surprise? Did we see any strategists changing their views off the back of it?
Yeah, actually, the strong rally was quite a surprise for many. And in fact, we see just over the past couple of days, strategists from JP Morgan and just yesterday from Bank of America raised their target price for both the Topix and the Nikkei index, citing continuous corporate governance reform, as well as companies potentially adjusting their earnings forecast upwards because of the weak yen is likely to continue for a while. And Goldman actually said that in January, after their discussion with their clients, they are seeing more clients in China saying that they're aggressively ramping up their coverage for Japan and showing more interest in adding a Japanese exposure for the rest of the year. So these are all quite positive signs pushing for a more solid growth in the market for the rest of the year.
So should we be worried at all about some of the overbought signals that could lead to some pullbacks?
Right. There are definitely some of the flashing signs. We're seeing that Japanese stocks actually is becoming more expensive. The valuation right now of the PE ratio has risen to about the average of average of its 10-year level. So some people are, for example, Goldman actually said that we might see some temporary loss of upward momentum given that Bank of Japan might be tweaking their policy earlier than expected. However, most strategists are still quite optimistic and bullish about the market. And when we look at the USD basis, we're still seeing Topix about 12% away from its 2021 high. So there's still room to grow, and the market overall still looks quite attractive.
That was our Asia equities reporter Winnie Su there from Tokyo. And sticking with Tokyo and the outlook for Japanese stocks, because earnings very much a focus, and Nomura are one of the names we're watching when trading in Japan starts at the top of the next hour. It's announced a buyback of up to some $677 million. That was as its key investment banking and trading division returned to profit. For more, let's bring in our Asia investing editor, Russell Ward. Russell, so just talk us through some of the key takeaways from Nomura's results here.
Good morning. Yes, these were very solid results from Nomura. We, as expected, saw a solid recovery in their retail brokerage business, thanks largely due to the stock market rally that Winnie just spoke about. Also, we saw very strong results from the investment bank. bucking sort of a global deal-making slump, then that's thanks to some strong deal-making flows here again in Japan. Again, that's due to the buoyant markets here. But then probably the most encouraging sign for Nomura was the return to profit from the wholesale side from a loss a year earlier, and that's really due to progress on cost cuts. Kentaro Okuda, the CEO, has been expanding cost cutting, and so the cost ratio fell from 96% of revenue down to 89%. So that'd be very encouraging for investors. And then we saw on the icing on the cake, of course, that you mentioned there was the buyback. And so overnight we saw in the US the ADRs of Nomura jumped 10%, and so we're probably likely to see a jump at the open in Tokyo in a few minutes as well.
Well, let's talk about Sumitomo Mitsui as well, kicking off earnings for Japan's mega banks later on today. What are we expecting there?
That's right. Sumitomo Mitsui is the first of the three mega banks to be reporting. We're expecting actually a drop in profit, but that's due to a charge it took on the sale of a rail leasing unit in the US, but that's already been expected. That's already been announced. And so just putting that to one side, I think we should expect some solid results from them as well. Japan's mega banks are all doing very well. They're all on target to achieve their full year profit forecasts. Sumitomo Mitsui actually raised its forecast last quarter, and now it's expecting record earnings this fiscal year. So, I think they should be on track for that. And of course, they've got some tailwinds in the works as well, with the shares having risen in recent months on expectations that the Bank of Japan will finally, scrap this negative interest rate policy that's been weighing on earnings and lending profitability at home.
All right, that was our Asia investing editor, Russell Ward from Tokyo there. And let's get to some other stories on the corporate front, sticking with lenders, because Bloomberg has learned that UBS is looking to cut about 90 jobs in its Asia private wealth and investment banking teams. Sources tell us the plan covers about 70 jobs at the private bank and 20 at its global banking division. The jobs that are said to be eliminated may include about 25 relationship managers and supporting roles in the investment and solutions teams, mostly in Greater China and Singapore. New York Community Bank Corp plunged by a record as investors worry it's now a harbinger of risks in the commercial real estate industry. The firm, which acquired part of Signature Bank last year, stockpiled cash as it contends with lending risks, including troubled loans for a co-op complex and office space, as well as stiffer regulation due to its size. The bank's provision for loan losses surged to $552 million. Up next, we discuss AmCham China's latest annual business climate survey amid a downturn in the economic region and continuing tensions between China and the US. This is Bloomberg.
The American Chamber of Commerce in China is set to release its latest business climate survey. The results show companies see tensions between the US and China as the top business challenge for the fourth year in a row. And even though China's attractiveness as an investment destination has rebounded after last year's sharp dip, the overall investment outlook from these firms does remain thin. So joining us now to discuss these findings, Michael Hart, president of AmCham China. Michael, some of these findings were reasonably encouraging. I mean, you found that American companies in China actually improved financial performance and profitability as well. But at the same time, around about slightly less than half still expect to struggle with profitability. So what's the disconnect here?
That's right, Paul. So in terms of the report, we do start by asking sort of general areas. So how is your business doing? What's the business environment? And as you said, how are U.S.-China relations going? And then we ask specific questions like, are you making any money? Are your revenues up? Are you planning to leave China? What are your biggest challenges, et cetera? So part of the disconnect is that our AmCham China member companies who have been in China for many years, they're committed to the market because of the investments they've made. They believe in China long term because of the large consumer market or because of the strong manufacturing and sourcing base. But there have been challenges. And so, as you said, the report in general is slightly more optimistic, but there are a number of concerns. And so we're calling this a yes, things are better, but, and there's a whole bunch of concerns in different areas. One of them is, do U.S. companies have equal access or national treatment? And this is one area where companies have been saying that they've been squeezed out a little bit by China's own policies to boost their own company. So that's a concern. However, as you said, there was a bit of a bounce back last year as we were just coming out of COVID, 3 years of COVID. Things have improved a little bit. The economy's gotten a little bit stronger than it was during COVID zero, but not as good as people expected. And on the U.S.-China relations front, there were a number of visits last year by senior U.S. officials that gave people confidence that the U.S.-China relationship is in a slightly better place.
Reading through your report, a couple of themes really stood out for me, and that was transparency, regulation. It just kept coming up again and again. What sort of issues, even anecdotally, are your members raising here?
Right. One of the questions in terms of the top 5 concerns, as you noted, number 1 was still U.S.-China relations, but number 2 was this lack of transparency or in terms of regulations actually being implemented. So in some cases, China has said, we are open for business. We want foreign investors coming to China and opening businesses here. But companies have said, even according to the rules, we're supposed to be able to trade. But often, for example, in government procurement, we're selling to state-owned enterprises. Often people take a pass and say, because you're an American company, because you're a foreign company, we're not going to buy from you. We'll buy from someone else. And so, to be honest, the results are varied. It depends on which sector you're in. We've seen the most optimism from companies who are straight consumer businesses, so those selling food and beverages and services. We've seen some of those in resources and industrial. So, for example, those who are, let's say, making cars, they're seeing a lot of competition from domestic companies, in some cases subsidies. But in general, companies are still optimistic that there's an opportunity here, better than last year as we came out of COVID, but still not yet at its full potential.
And so how do these issues play into company plans to invest in China?
Yeah, it's a great question. So one of the questions that we ask each year is China within is it your top 1 or your top 3 destinations for investment? So when your company looks to go overseas, how does China rank? And traditionally, China has been either a top 1 or a top 3 investment destination. Last year, for the first time in memory, China fell out of the 50% or more said it was. This year, it's bounced back. So in this case, companies are saying, yes, we will consider investing in China. Now, we think that's for a number of reasons. One of them, a lot of companies last year said they would look at investing back in the United States or look at investing in other places in Asia. And what they found is, of course, it's not easy to invest in a new country. We did say, if you're not going to invest in China, where would you invest? Last year, they said the United States. This year, the response is Asia. And again, we believe that's because the U.S. is now very crowded in terms of people trying to make investments that way. And because if your main customer is in China, and for most of our companies trading here, China is where they're primarily selling, you want to be close. And so China continues to win in the sense of it is a top 1 or top 3 investment destination for most of our companies.
Yeah, maybe Vietnam, perhaps one of the key winners out of that. What about the issues around talent retention? Is it any easier to attract people and to keep them in China these days?
Yeah, that's a great question. It's a bit of a conundrum, right? If you look at the statistics, there's a large number of Chinese young people who say they can't find jobs. And when we look at our member companies, they say they're having a hard time finding the right talent. That probably means there's a skills mismatch. The other question is related to U.S.-China relations. It comes into play in all kinds of areas. And HR is an area where we saw over the past couple of years where young talent was hesitant to work for an American company because of the negative sentiment in the on the U.S. in China. And that's gotten a little bit better. So certainly that's been one of the challenges. Another thing, of course, during COVID zero, when people couldn't travel, China lost a lot of people who left, including a large number of expatriates and their families who ran businesses. And so, for those who visited China 6-7 years ago and those who came last year, it's very obvious that foreign talent has left. And one of the things that China is trying to push is to get more foreign talent back here, and this will be a challenge. Of course, AmCham China pushes for people-to-people exchanges. We're looking for more students, more business people, more government leaders. Last year, as I said, we did see some senior U.S. officials visited China, which seems to be good. This year, I saw in January, actually 2 short-term groups of students, graduate students from the United States. So it seems that's a positive trend, but we're very well off the long-term positive and robust U.S.-China relations that we had a decade ago.
All right, Michael Hart, President of AmCham China, thanks so much for joining us with insights on your latest report. Here are some of the headlines that we're tracking around the world. Bloomberg's learned that talks are advancing for an agreement to pause the Israel-Hamas war and free civilian hostages captured by Hamas. Conversations are said to be still in the early stages, and a breakthrough isn't expected in the coming days. Sources say the proposal has a realistic chance of success and could lead to a longer-term ceasefire. If passed, the deal would amount to the longest pause and the biggest hostage release since the war began on October 7. Ukraine says a critical arms shortage means it's outgunned by Russia 3-1 as the war grinds on towards a third year. Kyiv's latest plea for allied help comes as sources say Ukraine's commander-in-chief has ignored an order from President Zelensky to step down. We're told General Valery Zaluzhny has refused the request to move to a new role following the failure of the Ukrainian counteroffensive against Russia. The Justice Department has charged 4 Chinese nationals with smuggling U.S. electronics to supply Iranian weapons production. They're accused of scheming since at least 2007 to ship parts used in the missile and aerospace industries through front companies in China and Hong Kong. Last year, the Justice and Commerce Departments launched a joint investigation focused on theft of advanced technology. Indian Prime Minister Narendra Modi is set to use his government's last budget before elections to offer new spending measures while avoiding a deficit increase. The economy's rapid expansion has led to a tax windfall for the government. Economists expect the interim fiscal plan to be delivered in Parliament later on Thursday, and they'll target Modi's election priorities with spending on farmers, women and young people. Now you can also turn to your Bloomberg for more on India's budget. You can go to TLive Go, that's TLIV Go, to get commentary and analysis from Bloomberg's expert editors. Our coverage continues on Daybreak Australia. This is Bloomberg. Nasdaq CEO Adena Friedman says the exchange is on track to meet its earnings and savings projections after last year's deal to buy Adenza Group. Friedman told us more about how the integration process is progressing.
With the acquisition of Adenza, we have our Calypso system, which provides risk management technology to banks. It gives them more ability to put more liquidity into the system. And if they manage risk better, they can put more liquidity into the markets. So that's the liquidity pillar.
Let me just pursue Adenza for a moment, because that is a big deal for you.
Yes.
It's very substantial. A lot of people, a lot of costs, a lot of revenue coming in. How is that integration going? Because as you know, most deals fail not because they're bad ideas, but because the integration doesn't get done.
Well, so first of all, it's been a great start to bringing Adenza into Nasdaq. We closed on the deal in November. We brought the team in right away. We created a new operating model where we have both Adenza and Nasdaq people leading the fintech division. And the financial technology division within Nasdaq now is comprised of market technology, the technology we provide other markets, our anti-financial crime suite, which is in that integrity pillar, and then also includes the Adenza products, Calypso, risk management, and Axiom SL, which is regulatory reporting. So we now have a very complete suite of solutions we can offer banks, brokers, and exchanges around the world to help manage risk, manage their exposure to capital markets, and also root criminals out of the system. I would say that it's going really well, David, because when we assess acquisitions today, we really do a deep dive on the culture. We think cultural alignment, values alignment is actually a critical component of success. And so as we've been bringing new companies and capabilities into Nasdaq, we make sure that we have cultural alignment, and that actually really speeds the integration along. And so we're off to a very, very strong start now with Adenza as part of Nasdaq.
When you announced the deal, you emphasized the future growth opportunities and what this could mean for Nasdaq. You didn't talk much about cost synergies, which is unusual. Mainly acquirers talk about how much money they're going to save. Now you're doing the integration. Are you looking at substantial savings as well as the growth? So
we are looking at both. When we announced the deal, we announced $80 million of net expense synergies, and then over a medium to long term, $50 to $100 million of revenue synergies from cross-selling and expanding the business. So we do feel like we're on track on both fronts. I would say that with the expense synergies, we have a very clear plan. a very clear path of execution. We expect to achieve that over the next 2 years. And then we have an upcoming Investor Day, and we'll provide more details to our investors around that. But it is off to exactly the start we wanted it to be, and we have a very clear understanding of where we're going with that.
That was the Nasdaq Chair and CEO Adena Friedman with our colleague David Weston. Let's get to other stories from the corporate front, and social media followers of Tesla CEO Elon Musk are backing his threat to shift the company's incorporation to Texas from Delaware. In a poll he posted on X, most participants have voted in favor of the move. Musk floated the idea of relocating after a judge in Delaware voided his $55 billion compensation package following a challenge from a Tesla shareholder. Republican presidential frontrunner Donald Trump says he would block Nippon Steel's deal to buy U.S. steel if he wins the November election. In December, the Japanese company announced it agreed to buy the American steelmaker for $14.1 billion. But the deal's been met with opposition from union workers and bipartisan lawmakers, Paul.
All right, these are the stocks we're going to be watching when trade opens in Korea and Japan shortly. Japanese banks in focus after Nomura's key investment banking and trading division returned to profit, and it announced a share buyback of about $677 million. We're going to be watching Boeing suppliers too after the plane maker's fourth quarter earnings, cash flow and revenue all surpassed analyst expectations. Keep an eye on apparel makers and retailers also after earnings reports from Adidas and H&M disappointed investors. This is Bloomberg.